Mark, let's talk about the markets in a bit more detail, in 3 minutes, in fact. And let's start with what's going on in the dollar. Dollar weakness, then, a theme, even if on screens here in a European time zone they look pretty flat. But dollar weakness, a theme. How long does that last?
It's a great question. We're getting at that time of year where we're getting those year-ahead outlooks at the moment. And people are back into this idea of generally calling for dollar weakness. Not as high conviction as they were last year, but for the last couple of years, they keep on thinking it's the year of the dollar bearishness, and it keeps on being wrong. So I guess the market's been slightly chastened on that idea, and the idea that they're a little bit more nervous about it. I think there's a general view that dollar is overvalued. It is quite expensive on most valuation metrics, but people are very nervous to call the turn. And I think it kind of depends on how aggressively or when you think the Fed might be starting to cut rates. That said, in the very short-term dynamic, the dollar has obviously been soft for the last month, but that's really only a November dynamic. I think that could probably continue into year-end. However, today is corporate month-end buying because they have a T+2 day settlement, and they're likely to be buying dollars in the very short term. So today, maybe dollar might bounce a bit, but overall, I think dollar can weaken into year-end.
That is really interesting. So a couple of days from year end, we take that into account. Mark, let me ask you about your latest thinking on rate cuts, because we have an interesting story. It talks about how much rate cutting is priced into markets next year, and one particular options trader pricing in as much as 250 basis points of cuts in 2024. I mean, that might be an outsized expectation, but how weak do you think growth and the labour market in the US have to get to justify the cuts that we currently have priced in for next year?
To get what they have at the moment, I think that's the soft landing scenario. I think what we've priced at the moment, I mean, you got to remember it's the weighted probability of all those expectations out there. And there's some people who think no landing, some people think soft landing, some people think hard landing. But the mix is ultimately, we are pricing in markets right across the board. Any asset class is generally pricing a soft landing. The idea will get slower growth US next year, but nothing dramatic. Now, I am very much in the camp that we won't get a soft landing. We'll either get no landing, as in we will not control the inflation problem. Well, obviously, inflation's continue to come down, but it'll re-accelerate again, and rates will have to go much higher. That's the no landing scenario. Or we'll get a hard landing. That's what I think. Now, of those two barbells, of the barbell outcomes, I believe or I ascribe a higher probability to a hard landing, and I think it will start relatively soon. So that's the camp that I'm in. But I do acknowledge that there's certainly a chance at the moment we still might get no landing, that the consumer might continue to be able to ride this out. We've still got the fiscal tailwind. We have policy which is not yet extraordinarily tight. So how bad do we have to get those aggressive cuts? Well, that is, if we get those 250 basis point cuts, that's a really extreme hard landing. That's a financial crisis. Because remember, even in the hard landing scenario that I think is the highest probability outcome, inflation is still sticky. Inflation is not going to come down very quickly. Of course, it'll be brought under control by a deep recession, but 250 basis points, that's very dramatic.